Good morning. You're watching Business World Live. I'm Danie Laurel. It's 10 a.m. this Tuesday morning here in Metro Manila. We are about 30 minutes into this trading day. Let's go straight to our top story. More than half of CEOs in the country are confident that their firms will hit growth next year, but overall confidence has fallen. That's amid COVID 19 related uncertainties. You can see on your screens here data from the survey conducted by PwC and the Management Association of the Philippines showed that 59% of 161 CEOs believe their companies will see revenue growth over the next 12 months. Now, this is lower than 88% in 2019 and 89% in 2018. The majority of those surveyed were in the tech, financial services, manufacturing, and outsourcing industries. The same survey showed that 83% of respondents said the country's GDP will recover within the next 3 years. Recall that the economy plunged into a recession in the second quarter, that's after shrinking by a record 16.5%. The government expects the full year figure to fall by 4.4 to 6.6%. The CEOs identified the key areas that the government should focus on for the economy to bounce back. These are healthcare, infrastructure, agriculture, and food security. Now, this just in, the Asian Development Bank sees a deeper contraction for the Philippine economy this year. The Manila-based lender forecasts the economy to shrink by 7.3% for 2020. That's deeper than its April outlook of a 3.8% contraction. The ADB says the economy is expected to rebound in 2021 when the pandemic is contained and when the economy is further opened and more government stimulus measures are implemented. The ADB believes the worst is now over and contraction has bottomed out in May or June. It now sees GDP to grow by 6.5% in 2021. Let's kick off markets with a check on our local unit. Take a look at our strengthening peso here on my terminal. We're trading at 48.425 to the greenback. Now, this follows us actually having already strengthened yesterday. That was Monday versus the greenback or the US dollar on the back of ease restrictions, at least in Metro Manila. This, according to analysts, when the government had ease restriction measures to help boost the economy while managing the pandemic, that led to the further strengthening of the peso. And we do also see some analysts now pointing towards the peso strengthening on the back of comments from the Banco Central, basically that they will, of course, be buying back some bonds, or there's a possibility that they may do so after President Duterte had signed Bayanihan 2 bill, which allows them the leeway to actually start putting in more liquidity into the fiscal space. Now, let's take a quick peek at how the global markets are opening today, at least on Tuesday. And first, take a quick peek at how Wall Street overnight performed. You can see on my screen here, Dow Jones up by 1.2%, S&P 500 as well. The Nasdaq enjoying a gain of 1.9%. This was after we had seen a very topsy-turvy trading week last week, particularly for tech shares. There were a lot of rotations going on in that space. Meanwhile, if you take a quick peek at our Asian shares, it's not necessarily the same kind of picture. You can see, for instance, over in Japan, they're opening on the back foot, down by close to 1% for the Topix, the Nikkei 225 as well, down by 0.8%. Now, over in China, they're seeing some flattish swings between gains and losses here, with Hong Kong actually still up by 0.2%. And over in Singapore, the FTSE Straits Times looking like it's opening in the green. That's up by 0.6%. That's together with Taiwan and South Korea enjoying some gains. So nothing very clear here on what the direction of trading in the region is going to be looking like, at least in the first 1 hour of trade. Now, Asian stocks seem to be drifting. That's after it had snapped already 2 weeks of declines on Monday. But one interesting thing, you've got the Chinese yuan that was steady after rising to the highest level in this year yesterday. Now, other economists looking very closely at some numbers coming out in China. Industrial production and retail sales data are due today. Now, another thing to be watching out for, at least tomorrow, still the FOMC decision by Fed Chair Jerome Powell. A lot are expecting the Fed to hold the rates in that decision, but more are watching the language on whether they are optimistic in terms of the US and global economy. That's going to be tomorrow. Meanwhile, there's still going to be some policy decisions over in the monetary boards of Japan, Bank of Indonesia, and the Bank of England. Now, I did take a quick peek at our own local boards. We are unfortunately starting at the back foot. Now, take a look at that. We're at 5,900 levels, still have not gone up that 6,000 levels, even as we were already running towards that yesterday. So we are down this morning by 0.8%. This after, as I mentioned, Monday saw us inching closer and closer to the 6,000 psychological levels. That's as investors are remaining optimistic. We were up by 0.5% yesterday. This from Timson Securities. We had opened lower yesterday, but eventually ended with a gain. Investors continued to feel positive about the gradual reopening of the local economy. Now, AAA's Chris Mangon echoes his sentiment, says investors are more confident in other sectors and the market will continue to be moving higher. However, value turnovers on Monday are showing how investors are still off the table. We just had trades worth 4.7 billion pesos. That's well below our average. Offshore investors, meanwhile, remaining net sellers. At least those outflows were reduced to just a little below 60 million pesos. Now, let's take a quick peek at our sectors here and which ones are staging that decline. As my terminal just loads here, you can see that it's all a sea of red. So it's really a broad-based decline here. Services leading those declines and dragging down the rest of the bourse. That's down by 1.3%. Properties as well, with pain of 0.9%. But everyone from financials, holding firms, and industrials, no one really spared from this sell-off here. Let's take a quick peek at financials. Those seem to be the ones less affected right now. But this after there's a lot of reports. We had already reported this, that the Bangko Sentral can now lend more to the Philippine government under Bayanihan 2, of course, to help boost the coffers that the government has to fight the coronavirus pandemic. So this allows the BSP to provide some funds to the government by buying back some bonds and releasing some funding, as long as this does not exceed 10% of the government's average income for the fiscal years 2017 to 2019. Effectively, the BSP can now lend the national government up to 850 billion pesos from the previous cap of 540 billion pesos. However, you've actually got not everyone excited about this. So for one thing, you've actually got S&P cautioning the BSP against excessive bond buying. So they're saying that emerging market central banks, not just the BSP, but even over in Indonesia, over in India, might be pushing too far in their bond buying programs, and this might lead to price stability and other risks. So in a report, Andrew Wood, he's at S&P, says that this might undermine investor confidence if the purchases result in debt monetization. So they, of course, said that if you do too much bond buying, we might not have the capability to respond to future crises. There might also be implications for the ratings of our countries. Now, he did mention that as of the moment, these have not spooked the markets yet because these are still emergency actions amid this COVID-19 pandemic. However, they caution if investors start to view this as a long-term structural feature of the economy, the monetary authorities could lose credibility. Now, recall that the Bangko Sentral has the ability to keep on printing money, and that's why they also must stay independent from the fiscal side, and usually they try not to intervene too much in the fiscal side, and they're basically saying that using this allows monetization, allows them to keep printing more money that might be used to fund fiscal deficits, and this is problematic. But Governor Diokno, of course, is mentioning that this is an unprecedented once-in-a-lifetime pandemic. It requires an all-of-government approach, and these are clearly time-bound. So this 10% additional monetary support is only for a period of 1 year, is what he actually mentions. Now, more on the BSP, you can see on my terminal here how our rates are approaching, even going further and further down. Nomura, despite that rate cut, is seeing even more rate cuts through the fourth quarter. So they're seeing 75 bips more to provide additional support to the economy because of the fact that the fiscal side is not enough. So they're mentioning that due to a weak recovery, the risk of a fiscal cliff and inflation well within the target because of this negative output might actually leave more space for the Bangko Central to act. Now, recall that you've got three meetings left this year. You've got on October 1st, November 19, and December 17. Now, speaking of Bayanihan too, I just want to take a quick peek at our airlines here. Our airlines are going to be awaiting some aid here. They've been clamoring for that aid. They have now said this from the Air Carriers Association of the Philippines, or ACAP, said that around 700 million pesos had been allocated for the local airlines from this recovery plan. So this is on top of the 10 billion pesos they expect from financial institutions, at least in the form of lending to the industry. So each airline we have, you've got Cebu Pacific, Air Asia, Philippine Airlines, etc., are expected to receive around 140 million peso loan. Now recall that the airlines expect a 55% decline in 2020 air traffic. That's according to IATA. You can see on my screens here, Cebu Pacific going against the tide, the red tide, that's actually up by 0.8%, possibly on the back of this good news of some help coming their way. Oh, you've also got Macro Asia enjoying a jump of 1.3%, while, however, remaining unchanged. Now, more on markets later on in the broadcast. We've got Chinabank's Securities Rastine Mercado. Let's check in on the biggest headlines we are watching this Tuesday morning. Car sales continued its slump in the month of August as Metro Manila and nearby provinces were placed in stricter lockdown for 2 weeks last month. You can see on your screens here that data from the vehicle manufacturing groups showed sales dropping nearly 40% year on year to at least 17,000 units in August. Now, this is down 12.8% from the sales in July this year. Sales plunged by nearly half from January to August, that's amid the pandemic. Commercial vehicle sales in August, which makes up 70% of auto sales, were down 40% year on year. Passenger car sales likewise fell 38%. Toyota Philippines, which remains the industry leader, said companies are unable to meet the volume requirement for a government program that offers fiscal support to car companies. Under the Comprehensive Automotive Resurgence Strategy, or the CARS program, car companies must produce 200,000 units of high-volume car models in a 6-month period. But despite this, vehicle manufacturing group Campi is hopeful that the ongoing evaluation made by the Trade Department will consider the pandemic's impact on the industry. Campi says it will be able to sell 240,000 units this year through, quote, aggressive promotions. Car dealers have started to lower down payments and even slash prices for new vehicles in an attempt to revive sales. Recovery for the industry, they say, may be an even more difficult task. Now, this from the Philippine Star. The Philippine Competition Commission is now set to issue guidelines that's on the exemption of merger and acquisition deals below 50 billion pesos from its review. This move is provided under the recently passed Bayanihan 2 law, which exempts M&As with transaction values of less than 50 billion pesos from compulsory notification, that's so long as these are entered within 2 years from the law's effectivity. Bayanihan 2 Act also suspends PCC's exercise of motu proprio review of these mergers and acquisitions for a 1-year period. Currently, the PCC reviews mergers and acquisitions with a transaction value of at least 2.4 billion pesos to assure that these would not restrict competition or harm consumer interests. Though some experts in competition law believe that the move may cause a spike of violations of competition policy, the PCC assures that they will step up enforcement activities to prevent abusive practices and anti-competitive agreements. Land Bank has granted 330 million pesos in loans for 4 schools. That's as of mid-August. That's under the Study Now, Pay Later scheme. The DOF said 6 more loan applications under this program are still up for approval, while 5 applicant schools have yet to complete their requirements. The Study Now, Pay Later program refinances or discounts promissory notes issued by students' parents, wherein schools can borrow up to 70% of the value of the promissory notes per semester and subject. The loan bears a fixed interest rate of 3% per year. Educational institutions eligible for the Study Now Pay Later scheme are private high schools, private technical vocational educational training institutions, colleges, and universities. So far, over 60 schools have expressed interest in the program, which is available until June 30, 2021. Land Bank also has an ongoing 1.5 billion peso lending scheme called iStudy, wherein parents can borrow up to 300,000 pesos to pay for their students' tuition fees. This loan carries an annual interest rate of 5%. With fiscal stimulus squeezed out and the central banks stepping in, the reopening of the economy comes with a lot of apprehension. Here to give us his latest assessment, we have Chinabank Securities' Rastine Mercado. Good morning, Rastine, and welcome back.
Morning, Danny. Great to be here.
Christine, let's take a step back to digest the
Mm.
policy and what's going on here. I mean, we're 6 months into this pandemic already. Finally, all the bills that have been pushed are now signed, sealed, and delivered. So it's time to assess whether this is good enough for the markets. This is something that needs to still be significantly improved. So let's talk about Bayanihan 2. It's still
Mm.
0.9% of GDP. The BSP is now being allowed to step in more. How risky is this to our economic recovery?
Well, I think in terms of fiscal stimulus, we have been trying to look at more of that. Bayanihan to certainly did deliver some of that. So I think bulk of the allocation is for government banks in order for them to loan out to businesses, specifically MSMEs, right? So that should help. It should help support businesses at least at the to kind of buoy employment and to buoy consumer confidence down the line. So that's a good thing. So there are still some measures that we're still looking at or we're still looking at progress from. So hopefully the Bayanihan 2 passage is a step into more fiscal stimulus measures being passed down the line. Although we do know that one of the main things that the legislative is looking to pass over the short term is the 2021 budget. So that's also equally important to fiscal stimulus measures. So as long as we continue to see those measures getting passed, then this should be good for the market. So I think again, it might be a good catalyst for our market if we see this kind of momentum from the Bayanihan 1 passage to continue throughout the next few months.
Okay, so it's not so much about the amount per se, but the fact that at least it's being passed and it's now entering into the system. What's your general feeling about the BSP stepping in and actually, buying bonds from the government and actually lending more money to the government, given that traditionally the central bank should be very independent and
Mhm.
should be, the check and balance, diba? And some investors I had reported earlier are worried to enter such emerging markets if this might be the case.
Well, I think that obviously the government is more concerned about fiscal policy, and then the central bank is more concerned about monetary policy. And over the past few months, the BSP has been doing just that. They've been looking at their policy rates. They've also been looking at their RRR. So I think that again, with any new tool in their toolkit, if they have mentioned that they will be exercising this with responsibility, and obviously the central bank has been very cognizant of how its actions or how its policy actions trickle down into markets. So I think we will continue to see that moving forward in terms of whether or not it will deploy that tool or not.
Are more rate cuts needed at this point? The Governor Diokno has said, we have not yet seen the effect on it yet. There's a lag effect. And
Mm.
in fact, we've still seen, the loan growth hasn't necessarily picked up even after this triple R cuts you've mentioned. And we still need to mop up all of that excess liquidity. But Nomura is calling a 75 bips cut in the fourth quarter if we are to keep this momentum going of an economic recovery.
Well, I think that as we mentioned, fiscal policy has been kind of lagging in terms of the delivery. So obviously, the central bank may be a little bit concerned about whether of supporting growth even further. So in terms of policy cuts, they might still do that. But then again, the BSP still also has potential RRR cuts in its arsenal. So I think they're still trying to look at how the unlocked liquidity is trickling down into markets. Um, Again, I think if echoing what the ECB, the European Central Bank, has mentioned over the past week, government in terms of fiscal policy should be more. They should pick up more in terms of dealing with this pandemic as well. So I think we do see that already with the passage of Bayanihan 2, and it's just a matter of sustaining it. And I think part of that also is getting some key legislative measures that have been kind of a question mark over the past year or so, like the Create Bill. So hopefully we do see that getting resolved. So I think as long as those get cleared up, then I think that should be good momentum for the market and the domestic economy.
Would it be a positive catalyst for the markets if the BSP did ease even further, even as we're already in negative real rate territory?
Well, there's also a view that in terms of incremental positive effects in the market, further rate cuts might not be as strong in terms of uh, m- investors reacting positively to it, considering that we're already kind of at the negative real interest rate territory. So that's why there's that need for fiscal stimulus to kind of kick in and help support the increase in liquidity in the markets.
What are you watching in terms of the Fed decision? Is that going to be, because it's very closely watched, but at the same time
Mm.
it's quite expected that there's nothing's really going to happen. Also, ECB largely expected not to move. So what kind of language are markets pricing in or hoping for?
I think what markets are looking for is a little bit more clarity or direction as to how the Fed views its policy moving forward. So I think they did mention that they will be shifting a bit to be a little bit more tolerant into increases in inflation rates over their target of 2%. So a little bit more color on how they see that progressing over the next few years, because obviously we do have a period now of interest rates being at lows, right? So how that's going to progress over the next 3 5 years is important for investors and businesses as well. So a little bit more clarity on how tolerant they will be in terms of inflation overshooting their target, and also what their view is on unemployment. So which is one of the main things that they're actually looking at this point in time.
Okay, so the job losses figures there.
Mhm.
Racine, let's move on to the local index here. Just from a technical perspective, did you really see an impact of the ghost month in the trading volumes? Is that what you can, credit the low trading volumes to? And do you actually expect a surge, whether it's tomorrow or in the next couple of days when this ghost month is over? And are investors actually positioning for that? And which stocks are you watching out for?
Well, over the past few weeks, we have been seeing lighter trading volumes. Net foreign fund flows continue to go out of the market, although we did see kind of net foreign buying last Thursday, which is a good sign. So again, it's a matter of whether or not this will be sustained. So any sustained net foreign buying is a good indication that foreigners are flocking into the market again. In terms of technicals, the market is really still in consolidation mode. So hopefully, we do see that kind of picking up, hopefully transitioning into an uptrend. But then I guess markets and investors will be waiting for third quarter earnings as a possible catalyst, because if we did see the worst in the second quarter, then the third quarter certainly would provide some direction as to whether or not we're recovering faster or at the pace that
Mhm.
we are expecting. So hopefully we do see better market traction coming off the heels of that. Uh, Again, outlook for the next year is going to be as equally important, especially as markets kind of tune out the downgrades for 2020 GDP, and I think they're focusing more on what next year is going to shape up like, right? So hopefully we do continue to see good economic data coming out, so sustain improvement in remittances, sustain improvement
Okay.
in consumer confidence and business confidence. So all of these, if they do continue and they do persist, will point to a recovery really in the works. So I think that would buoy market confidence, which could propel the index higher.
Are you already seeing inflows coming in? Because there was one day of major inflows, and then, but it does
Mhm.
seem that the outflows at least are paring back. And do you see this already relating to the better market activity in terms of trading volumes?
Well, it's still a little bit choppy in terms of foreign fund flow. So there were a couple of weeks that we were kind of optimistic that maybe this is the inflection point for foreign funds. But again, as you did mention, after a day of strong foreign fund flows, the next few days turn into outflows. So it's really still not. There's still no direction with regard to that. But in terms of liquidity, if there's strong trading volume on major market moves, hopefully upwards, then that should be seen as a strong move with investor conviction. So hopefully we do continue to see that in terms of technicals. If we see a breakout of 6,100 with strong
Mm-hmm.
volume, then that might be indicative of further strength ahead, which may see the markets go higher to 6,450 or 6,500. So hopefully we do see that, especially as we're coming off the tail end of the year and as we're looking into potential earnings recovery in the next year.
Let's talk about those earnings recovery. How sure
Mhm.
are you that the second quarter earnings are already the lowest of the low we can go? To were those disappointing for you, or were those actually pointing towards a slow recovery at least in the third quarter? What are you pricing in?
Well, for the second quarter, it's mostly weak because obviously we did see the most restrictive lockdown measures in place for the second quarter. For the third quarter, we did see kind of a resurgence of that in August when we re-implemented more stricter community quarantine measures. So that might kind of come into play in terms of earnings recovery. So, but given that the restrictions were in place for most part of the second quarter versus the third quarter, then the third quarter should relatively be better. So how better the third quarter is what we're all kind of trying to gauge.
Okay.
So hopefully we do see significant improvement, and then it's just a matter of being able to sustain that recovery.
Okay, so you think that it's a matter of the lockdown and not necessarily the long-term economic effects that will pull down the third quarter earnings?
Well, I think obviously we do know that consumer confidence might have been impacted, especially with unemployment picking up. So again, that's why it's really hard to kind of gauge which sectors will come out front among the others. For now, we still stick to what we know, and that's your retailer of consumer staples, your manufacturers of consumer goods. So these are the ones that have historically been resilient, and we continue to see being more resilient moving forward. So again, we're still trying to ascertain how long-term effects of the pandemic on consumer and business spending is going to be and its impact on specific industries. So hopefully we do get a little bit more clarity on that as the rest of the year unfolds.
Okay, and last question before I let you go, because you're talking about this off cam, about the vehicle sales here going
Mhm.
down, but also them still being optimistic that this will be picking up. But this is something like a discretionary item that the
Mhm.
consumer, even before the pandemic, they'd already had some issues in terms of vehicle sales. It was finally picking up, but because of the excise taxes and all of these things, they had
Yeah.
some headwinds. How telling is this of the strength of our economy, and what's your outlook on that?
Well, I think that in line with dented consumer confidence because of the pandemic, so obviously consumers aren't as inclined to make big ticket make big ticket purchases at this point in time. So obviously that may have trickled into the weakness in car sales. But then if you think about it, 2018 was when they suffered the most decline. So that did improve in 2019. So again, this pandemic, so hopefully it's all tied down to consumer confidence. If consumers continue to experience, like, if unemployment rates go down, remittances get
Mm-hmm.
better, then we might see a pickup in these big ticket purchases. So again, it's only when that recovers that we might potentially see a sustained recovery in vehicle sales.
especially since we actually have the low interest rates to support that and the
Mm-hmm.
liquidity in the banking sector if they do want to get loans to buy these vehicles. Thank you so much for those insights. That was Rastine Mercado of Chinabank Securities.
Thank you.
And that's the first look into the business day. Today is Tuesday, September 15, 2020. Catch us again tomorrow morning, 10 a.m. I'm Danie Laurel, and we are One News.